Hey there, fellow finance enthusiasts! Today, I want to discuss the perfect storm of recession, stagflation, and debt ahead by Nouriel Roubini.
I do believe that this stagflationary crisis is going to emerge this year. The latest numbers on inflation coming from the US and Europe and other advanced economies show that the inflation now is quite sticky, both price and wage inflation. We still have a number of negative aggregate supply shocks. Central banks are in a dilemma because they have to raise rates more to fight inflation.
Get ready for an economic escapade that will make your head spin faster than a merry-go-round in turbo mode. The economy is on a downward spiral. Jobs are vanishing like socks in a washing machine, and incomes are shrinking faster than ice cream on a hot summer day. And inflation is lurking in the shadows, ready to pounce and snatch your hard-earned cash faster than a sneaky pickpocket. But hold on to your hats, because we're not done yet. Stagflation crashes the party, throwing a curveball that would make even the most skilled jugglers drop their flaming torches. Job prospects are as elusive as a unicorn sighting, and your wages are locked in an epic battle against skyrocketing prices. It's like trying to escape quicksand while juggling chainsaws. Now that's what I call a show. And let's not forget about the debt monster lurking in the shadows, waiting to strike fear into the hearts of even the bravest souls. It's like walking a tightrope while balancing a tower of debt on your nose. Talk about a circus act that would impress even the most fearless acrobats. Time for the economic adventure that will make your adrenaline rush like a squirrel hopped up on caffeine. Remember, in times of economic jitters, laughter is the best medicine. So grab a tub of buttery popcorn, sit back, and enjoy the show. Whether we get a happy ending or a thrilling cliffhanger, one thing's for sure. This wild ride will leave us with stories to tell for generations to come. Let's plunge fearlessly into this whirlwind of an economic drama and navigate the twists and turns together. Let's start with Nouriel Roubini's encounters. First of the common queries is about the likelihood of a global recession primarily driven by the United States.
Well, I would say it's certainly more than 50%. Caveat on global recession, US and Europe are going to have an outright economic contraction. Some countries like India are going to do okay. China is going to have some pickup of growth because they're eliminating their zero COVID policy. So there'll be a recession in most advanced economies, maybe with the exception of Japan, and a sharp slowdown of growth in the average emerging market.
The overnight surge in the 10-year U.S. Treasury yield has raised questions about the ability of the U.S. Federal Reserve to control inflation. Some wonder if a cash rate of 5.1% would be enough, or if it would need to go even higher, say, to 6%. The market currently doesn't anticipate rates reaching 6%. However, according to Nouriel Roubini, in order to achieve a 2% inflation target, the Fed funds rate would likely have to surpass 6%. Nevertheless, raising rates to that level would lead to a significant economic downturn, resulting in a crash in financial markets, a correction in equity markets, and an increase in borrowing costs for the private sector. This financial distress would exacerbate the recession, leading to a higher number of defaults across various sectors. As a result, there would be a negative feedback loop, where a more severe economic contraction would contribute to a worse financial crash, and vice versa. Roubini believes that central banks would eventually retreat from such a scenario due to the detrimental consequences. However, this realization would anchor inflation expectations at a higher level, resulting in more pronounced wage price patterns and inflation not reaching the desired 2% target. Roubini suggests that central banks may have to accept higher inflation rates in the mid-single digits.
The wage price patterns are going to become more severe, and inflation is not going to reach the 2% target of central bank. Is going to be somehow higher in the mid-single digits.
Regarding the potential inflation levels, Roubini points out that it may not reach double digits as it did in the 1970s unless there is a significant geopolitical shock, such as a conflict between Israel and Iran. Such an event could cause a spike in oil prices, potentially reaching $200 per barrel. While these shocks in the 1970s led to stagflation, a combination of inflation and recession, Roubini highlights that the current situation is more challenging due to the significantly higher levels of public debt compared to the aftermath of the global financial crisis. With debt ratios at 420% of GDP in advanced economies, high interest rates resulting from inflation and recession could lead to an unsustainable debt burden. This could trigger a great deflationary crisis, where deflation or lowflation combines with a debt crisis, creating a perfect storm of inflation, recession, stagflation, and the potential for a debt crisis. Will China's speedy reopening save the day by balancing supply and demand and curbing inflation, or are there sneaky factors lurking about? Well, there's more to it. Even with their zero-COVID policy, China managed to keep production going through production bubbles. But now, as they aim for a 5% growth this year, look at them go. Their thirst for commodities like industrial metals, green metals, oil, and natural gas is skyrocketing. The problem? Supply bottlenecks. There hasn't been enough investment in new energy and metal capacity. So brace yourself for a potential commodity price explosion. Goldman Sachs predicts a 43% hike this year, and that's without any fireworks in the Middle East. If prices go kaboom, brace for higher inflation that'll surprise the markets. Looks like our landing might not be as smooth as we thought. Hold on tight. Second question, what will a stagflationary environment feel like for the general population if it does come to pass?
When there is a recession, incomes fall, wages tend to fall, and people lose jobs and lose income. But when you have a recession with a lowflation or deflation, at least inflation is not eroding your purchasing power. When you have overheating of the economy and inflation is high, maybe prices are rising greater than wages.
An overheated economy with high inflation can lead to prices rising faster than wages, resulting in a decrease in real wages. However, even in that scenario, having jobs available provides some level of stability. Roubini emphasized that stagflation is the most challenging situation as it combines the negative aspects of a recession and high inflation. It brings about job losses, a weak labor market, and wages that grow slower than inflation. This creates a significant impact on workers and individuals who rely on labor income and wages. Stagflation is a scenario where everyone suffers, as real wages decline due to prices rising more rapidly than wages, and some individuals experience job losses and reduced income. Overall, Nouriel Roubini shed light on the detrimental effects of stagflation and its implications for the labor market and individuals' financial well-being. Lastly, how can investors insulate themselves from inflation beyond the traditional inflation hedge being gold?
Well, normally the price of equities and the price of bonds are negatively correlated. That's why some investment advice says 16 equities are more risky, 14 safer bonds. But that assumes that inflation is low and stable. Risk on, risk off, growth, recession. When equity do well, bonds do poorly, and vice versa. But when inflation is rising, like last year, the discount factor for equity is higher, the long bond yields, equity fall, and a higher bond yield means the price of the bond is lower, so you lose money on your bond as well. Last year, actually, bond yields rose so much that you lost more money on your bonds than you did on risky assets like US and global equity. So the correlation becomes positive. So the traditional investment advice fails, then you have to go to stuff that can hedge against inflation. One, as you suggest, is gold. Another one is inflation index bonds. A third one is short-term bonds whose yield goes higher and you don't have the price impact that you get on long duration bonds. And the fourth one will be sustainable forms of real estate, because real estate is in fixed supply. When there's inflation, tends to be a good hedge against inflation, better than equities. So you have to think about a very different portfolio from the traditional 60 equities, 40 safe bonds. Those safe bonds are not safe when inflation is higher.
Last year, they took a tumble due to inflation fears and tighter monetary policies. There was a glimmer of hope at the beginning of this year when the market expected inflation to vanish like a magician's trick. Central banks were even predicted to do a 180 and start cutting rates by the second half of the year. But hold on tight. Recent reports on inflation in the US and Europe suggest that it's here to stay, like that clingy relative who overstays their welcome. The Fed and friends might have to pull out all the stops and raise rates all the way up to 6%. And guess what? The market is already throwing a tantrum. Bond yields are on the rise again, and in the past few weeks, it seems like your precious equity investments and bonds are having a competition on who can lose you more money. It's like a synchronized nosedive, and it's hitting your traditional portfolios right in the gut. It's a perfect storm that will make your head spin, your heart race, and your bank account cry for mercy. But hey, at least we'll have some thrilling stories to tell our grandkids, right? So grab your popcorn, fasten your seatbelts, and get ready for the wildest ride of your financial life. Nouriel Roubini has spoken, and it's time to face the perfect storm with a smile on our faces and a sense of humor in our hearts. Let's hope for the best, and if all else fails, at least we'll have some hilarious tales to share at the next Economic Comedy Club. Stay strong, my friends, and remember to laugh in the face of adversity. What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to Finance Zoo channel. I'll see you in the next video.